Today I'm going to talk about the unique challenges that the industry is facing, very similar to what Money mentioned. What I'm going to do slightly different here for you is give you the perspective from the online commerce industry. As you can imagine, the online commerce industry is an industry that all FI should look at as an industry they can learn from. And since we work across financial institutions as well as online commerce, we realize that really the champions in onboarding and customer experience are actually the online commerce or e-commerce industry. So I'll give you some perspectives from there and also blend in by way of example what you can learn from that. Okay, so let's get started. So the first thing to note is that the market is going through a crazy level of inflection points or discontinuity. So usually there are many discontinuities in the market. There are things like recessions almost every decade. There are structural shifts in the market that often driven by things like regulation, as you are well aware of in the financial space. What's happening right now is a lot more unique since it's a mix of two major inflection points. So if you look from the online commerce side in particular, on the left, you see what is online commerce in the US as a percentage of total retail. And as you can see that online commerce has been taking share from the retail commerce by a couple of percentage points every year. So until 2020, it was 2 percentage points and it reached up to 15 to 16%. But within a quarter, within 3 to 4 months, actually, it jumped up to 27%. That's about, you can see what happened in a decade. It moved up, the amount of share that e-commerce took from retail commerce in a decade moved up in less than 3 to 4 months. Now that's crazy. And you know, some of us, you can imagine, we'll go back to retail, like normal physical stores when the world reopens, but a lot of behaviors have changed. So not all of this will come back. And as you can see, Satya Nadella mentioned in the Mint article below that in 2 years about 2 years of digital transformation in 2 months. On the right side, you see there's a stark contrast when you see the GDP. We've hit the worst economic recession, at least in the US, globally too, and the GDP is shrinking by 33%. Now, the coexistence of these two trends literally blows your mind. You can observe very strange things going on. You can observe the tech-initiated boom in the stock market, which you would not expect in a recession. And you know, our industries are also affected in strange ways. So let's talk more about that. So this strange story of two inflection points leads to a very rare fraud challenges and things that impact things like onboarding. I will talk about the top 3 that I see from my vantage point. So first, we are hitting an unexpected pattern in online buying behavior. Once again, you are seeing new buying patterns. The folks who fight fraud tend to use historical patterns. As Money mentioned in his presentation that people are utilizing machine learning a lot these days. And the way machine learning models work is that they use historical behavior and they use the historical behavior to model the future. But there is no historical behavior to go by in these strange times. So it also takes a very long time to get outcome of what's fraud or not. So, you know, there is no outcome behavior to model by to. So that's one. The second is the surge in new account openings. And this is in commerce and banking all over the place. And we are seeing that in our data, like because we work with all of these institutions. The surge is expected because people are forced to go, for example, in the case of commerce, online commerce. What's interesting is that there is a significant decrease in the level of brand loyalty at this time. So traditionally people, and this actually happens in every recession, that the brand loyalty decreases and people look for alternatives. Now, this matters a lot because it is still further increasing the amount of new account opening that will happen. And you can imagine if you start ditching your previous brand and start going to new brands, which is, again, and we just talked about things like challenger banks. It's not like challenger banks are getting a big increase in onboarding these days, but people are also moving to other institutions. So that also, again, the challenge with new accounts and monitoring a new set of customers is that you don't have historical data to go by. Just a quick time check. Now, if you look at the third one, recession, of course, leads to an increase in fraud. What happens during recession, there is increase in third-party fraud because people who are cash strapped, even the fraudsters get more desperate and they resort to more fraud. And you see a lot more of first-party fraud too, because people are more careful with their money. And you know, there's certainly an increase every recession of friendly or first-party fraud. Now you change that to the implication to the graphic on the right. You know, you look at the graphic, you will see that the cost of fraud is about $30 billion card fraud, according to the Nielsen report. And the actual cost of false declines is more than 10 times that, which means that there's a lot more customer abuse, like just to catch fraud or to keep the bad guys out, you are leading to a lot more false declines and impacting good customers. So how do you solve for that? And that's where it's the value of digital identity comes in. I'll tell you how Ekata defines digital identity. Now, we all live in digital and real worlds, and they are, you can think of it as this double helix of interconnected physical and human and digital sides. The reality lies on the physical side, that is the human side of the helix, that is you know, where you and I reside. On the digital side, we only know what people say they are, but we can't be sure, right? Like they are online, they are not real people. And I mean, you cannot know whether they're real people. We can think of digital identity as a collection of attributes that are true and useful for verifying an identity. So examples could be things like name, age, email, phone, you know, several things that you use on things like eKYC, but even beyond that. And these attributes are ideally somewhat stable, and there is a way to figure out whether to validate them using data. So that's what we do. Now, talking about a little more details about it, we generally see, and I like to present this to every financial institution, just to highlight the importance of dynamic identity elements. So the historical school of thought has always been to try to get to a definite answer on validating identities. So, you know, this camp would include things like government issued static identifiers like social security number, photo identification. Usually this kind of data is very country specific, and usually credit bureaus provide this kind of data, which do not exist across multiple countries. And it can also be compromised from, you know, it's usually compromised data from data breaches. The other school, which is what is the school we subscribe to at Ekata, it utilizes dynamic identity elements such as phone, email, address, etc. Now, we admit that you can never get to the perfect answer, and you have to get to a probabilistic answer, and that's what we call probabilistic risk assessment. These data elements are difficult to assemble globally, and you know, they are very hard to handle because it's not easy to get by a normalized address elements. It's not easy to get the right email or phone number associated with people. But that, if you get that information, you can use that for making very good probabilistic risk assessment. Moving on for the interest of time. I'll very quickly, I won't go through all of the elements that I mentioned over here, just to very quickly tell you how Ekata helps over here. let's look at some of the most predictive digital identity signals for detecting stolen and synthetic identities. Um, Now, these are the ones that provide most value in our experience, of doing data tests with thousands of customers. We split them into three categories. The first is linkages, that is the connections between elements. Then there's metadata, which is additional data linked to an identity element. Uh, and I'll give you examples of these. So, and third is usage patterns that are essentially observing online behavior in things like an identity network or an online network. So giving you examples of each one of these. In linkages, the primary linkages between identity elements, such as the link between your name and your phone number, or your name and your email, or all three of those and an address linked together, as you can imagine, is very valuable information. It's either a fraudster can duplicate one of them, they can try to get your name and your address, but getting also the email attached to that, because they'll likely like to keep their own email, is very hard to do, and so on and so forth. So the linkages give very valuable information. You can also do things like link between the distance between an IP and phone number, which is very predictive of risk. On the metadata side, there are things like the elements that will tell you a little more about the identity elements, the attributes that will tell you a little more about the identity elements. So you can think about phone line type, getting to know whether it's a voice over IP phone number is an indication of risk. In usage patterns, there are things like email first seen. So, usually fraudsters will create a new email. They would, or their own email where they would like to get things delivered. Of course, they'll not use their own email. It will be a freshly created one. So less than 3% of authentic emails online that people use are actually less than a year old. That's a very interesting statistic. And you can, in reality, the amount of traffic we see of fraudulent emails or like recent emails is way higher, way over 10%, which is indicative of fraud. And of course, all of these put together add a lot of value. And this is the kind of dynamic identity elements that almost everyone has started employing in the industry. Just a quick time check. Am I over my time? Am I done with my time?
Still got around 5 minutes left at the minute, and then we would take probably 5 minutes of questions. But at the minute, I haven't seen any questions yet, so you may have just over 5 minutes, I'd have said.
Okay, great. I just wanted to make sure whether I should present my last slide or not, because it lies in isolation. So, it's always fun to see things in practice. And this is an example of how we do it in practice. And these are contour maps, some pretty colors there. But let me at least tell you what the axes are and what these charts are about. These are heat map charts. Each one of, let's talk about the axes. On the horizontal axis, you see what we call Ekata's confidence score. This is a machine learning driven score that takes all the identity inputs, things like name, email, phone, IP, etc. And you can even give a partial list over there. And it evaluates the risk of the online transaction. It ranges from 0 to 500, from low risk to high risk. The vertical has Ekata's identity network score. This is also a machine learning driven score that evaluates the risk based on the usage patterns in our network. So, if you see a spike or a velocity increase in a certain element that is unexpected, or you see a certain combination like multiple emails attached to one address, that usually is an indication of risk. Many things like that. We have hundreds of signals like that. Now let's talk about each of the charts. This is something that we did for one of our customers, which we saw their data, and we worked jointly with their teams. And on the top left, you see the transactions that were verified good, and you can see that the verified good transactions, you can see the heat map kind of peaking at the bottom left, which means that whenever there is a low confidence score, that is in what we see as those links and metadata related risk, and low network score, that is on a network we don't see any crazy unexpected behavior, that is almost certainly indicative of very low risk. These are legitimate customers. You also see on the bottom left, these were actually the verified fraud transactions. And you can see almost all of them have got high confidence score, that is, which is like higher risk in confidence score and higher risk on network score. So this just tells you how predictive these are. Of course, it's predictive for catching fraud, but what I'm more interested in is look at the graph on the right. This will tell you the rejected transactions that the customer made. And these are all the rejected transactions, but if you see at the bottom left, which are usually should be very good customers, they were about 20% of this decline transaction. Now that's a big number. The problem with declining good customers is that you lose the customer for life, right? Like you lose their lifetime value. And when in the world of onboarding, I would say that it is very important to use identity elements like this and use techniques like what Mani mentioned as machine learning to figure out and not cause this customer abuse, like onboard more good customers.